Chapter 11 provides an overview of some basic lending vocabulary. Over the years, the basic go-to loan for home ownership has been the 30-year fixed-rate loan. That means a borrower has 30 years to pay back the loan for the money borrowed. The borrower makes monthly payments. The payments include principal, the amount borrowed, and interest, which is the cost of money. Since the bank does not have the use of the money to invest in other ways, the interest will cover the costs of inflation, overhead expenses, and opportunity costs of foregone investments. The interest rate is fixed. If during the 30-year holding period of the loan inflation escalates, the bank is unable to raise the interest rates because contractually it is fixed. It's rock solid. 30-year fixed-rate loans are amortized. That means part of each payment covers the interest expense and payback of principal. Remember, a bank is a business that wants to make money. It wants to make the most money possible in competitive financial market situations. So, as the borrower makes the first payment, how much of that payment covers interest and how much is paying back principal? Which is the bigger percentage? The loan table illustrated is for a 20-year loan with an interest rate of 11% and initial principal of $2 million. Note the payment over the year stays the same. Note in year 1, the interest payment is $220,000. So the payment, reducing the principal, is $251,151 minus the interest of $220,000, big number, would be $31,151. After 1 year of payments, the new principal balance is $2 million minus $31,151, or $1,968,849. Clearly, the bank is most concerned with getting interest paid first. Equity is a term you will hear often in talking about real estate. Equity is the difference between the value of the real estate and the debt obligation still remaining or encumbering the real estate. Equity is accumulated in two ways: reducing the principal amount owed by making regular monthly payments, and appreciation of the real estate. Points is a term associated with getting a loan. For example, currently the rate for a 30-year loan is about 3%. However, the bank will give a lower rate on which your payment is based if you give them money up front, called points. If you are willing to give the bank, say, 1.5 points up front, then your interest rate might be more likely to be 2.75% rather than 3%, and your payment is based on that interest rate. If you were getting a loan of $300,000 and paying 1.5 points to buy a lower interest rate, you would pay the bank 0.015 times $300,000, or $4,500. An FHA loan is a loan offered by the bank but insured by the Federal Housing Administration. The down payment is typically about 3%, but there is a substantial insurance premium. If the borrower of an FHA loan is foreclosed on, the Federal Housing Administration limits the loss potential for the bank. A VA loan is similar in that banks are insured against losses by the Veterans Administration. The VA loan is available to military personnel who have served with sufficient time to qualify. Typically, there is no down payment required for a VA loan. PMI refers to private mortgage insurance. It is offered by private insurance companies. Often a lender will require a 90% loan, meaning 10% down payment, to have PMI. The less the equity, the greater the risk to the lender. PMI is paid by the borrower and is usually part of the monthly payment. PMI also insures the bank against potential loss due to foreclosure. PMI can be removed at the borrower's request, but is based on the value of the home having increased to a lower loan-to-value ratio. A loan-to-value ratio is the value of the home estimated by a licensed real estate appraiser divided by the current outstanding loan balance. Once an offer to buy has been accepted, the borrower and seller must begin to provide documentation to the escrow agent who will facilitate closing. The main documentation is provided on the buyer side of the transaction. If there is a loan involved to facilitate payment of the purchase, bank underwriting has a big task to perform. The borrower will provide the bank with a loan application. The application gives permission for the bank to obtain a credit report, gather information about employment history, etc. The application will also provide information about savings and other assets that will be used for the down payment. This process by the bank of gathering information is part of the underwriting process. In addition to information about the borrower, the bank will hire an appraiser to complete a report on the market value of the property. Remember, the value of the property is important in considering a loan-to-value ratio. The lower the loan-to-value ratio, the less the risk associated with the loan. Again, loan-to-value ratio is the amount of the loan liability divided by the appraised market value. Once the underwriter has gathered all pertinent information, ratios are calculated. The housing ratio is the payment amount, that is the sum of principal, interest, property taxes, and insurance. Homeowners insurance is required for a loan, which is divided by the verified household income. The housing ratio is monthly PITI, principal, interest, taxes, and insurance, divided by monthly household income. The debt-to-income ratio is also calculated. It is monthly obligations, including the new PITI, divided by monthly household income. Banks usually like to see ratios around 25% for the housing ratio and 36% for the debt-to-income ratio. However, high ratios may be offset by a low loan-to-value ratio or extra assets that could be used to either increase the down payment or provide reserves that could be liquidated to make housing payments. Making good loans is a key to banks making profits. In the underwriting process, banks do what they can to give a yes answer to a potential borrower. This concludes the summary of key points in Chapter 12. Chapter 13 explains where real estate financing can be obtained. There are many national, regional, and even local banks that have loan officers that specialize in helping customers obtain real estate loans. Credit unions are typically on a regional basis and also have loan officers specializing in real estate loans. Then there is the mortgage broker. A mortgage broker acts as an agent for the actual source of financing. Mortgage brokers themselves do not provide the financing. A broker may have arrangements with many different sources of financing. Many banks, credit unions, pension funds, insurance companies, etc. The idea of a mortgage broker is to shop for the best fit for the borrower in terms of rates, underwriting criteria, availability of funds, etc. In terms of types of financing, there are basically two types, an amortized fixed-rate loan and an adjustable rate loan or mortgage called an ARM for short. The fixed-rate loan can be different time lengths. The most typical is 30 years or 15 years, but it could be for 20 or 10. As explained earlier, the interest rate is fixed, as well as the payment. The bank wants to get their interest earnings first. In the first years of the loan, more is paid to interest than to principal. Principal is the initial amount borrowed. Over time, the interest part of the payment becomes less and the principal part of the payment becomes more. As the principal payment gets bigger, it is creating equity for the borrower. A 15-year fixed-rate loan will have a lower interest rate because the bank is getting the principal back faster. The trade-off is that the payments are higher. The 15-year loan is squeezing the 30-year loan down so the principal and interest are paid faster. The ARM loan means that the interest rate is not fixed, but will fluctuate according to what interest rates are doing in the money market. ARM loans are more popular in high interest rate markets. This is because of lower start rates and lower initial payments. The ARM loan has two major components that make up the interest rate on the loan. They are the index and the margin. The index is tied to a well-known index of interest rates, and the margin is a set percentage which basically covers the expenses of the loan incurred by the bank. A number of years ago, I had an ARM loan that commenced when interest rates were high, and over the years, interest rates were declining. This became a favorable loan for me because as I was making a higher payment based on a higher interest rate, more was being paid towards principal, and over time I was able to pay off the loan in a much faster way. Okay, thanks for your attention. Stay tuned for future YouTubes.